Tell us how the ride has been for you, because some assets are well and truly down still, others have shot much higher. What's the wash-up post-Brexit been for your portfolio?
It's a bit like dropping a rock into a pond, isn't it? You know, you get the ripples. The ripples are always biggest, closest to the epicenter of where the stone goes in, and then it ripples out. So I think that, you know, the UK and Europe in that regard look most vulnerable, and the further away you get from Europe, things look better. But that doesn't mean where companies are domiciled, it means where their activities are. So, you know, within the UK, you look at the FTSE 100 has done fantastically well, really, since Brexit, surprisingly well. FTSE 250, the small caps, have been very badly affected, and that's all to do with their exposure to the UK economy. You know, the overseas earners, the overseas, the dollar dividend payers in the FTSE 100, they're doing pretty well. We
had a bit of a tussle last time you were around the set about your strategy of loading up on some UK assets prior to Brexit, and I thought there was a bit risk-loving coming into a key vote. You liked those assets because you thought a Brexit vote would not be for a leave outcome, it would be for a remain. So regardless of the reason, you still proved to be correct on buying UK assets. Just the reasoning was a little bit wrong. How did you feel about that?
I probably wasn't the only person to get that one wrong.
But you actually probably did better based on a Brexit vote.
Yeah, I mean, I think, you know, clearly UK assets are under pressure, and we've seen this with, you know, with the commercial property sector. But I do think, you know, there's clearly a price for everything, and the movement in the exchange rate since Brexit has really, you know, changed the equation quite significantly. So, I mean, we've seen today with the acquisition or the bid for ARM. We had the bid last week for Poundland. You know, UK assets are really starting to look quite interesting to overseas buyers.
Come on, let's run with your pond analogy here for a moment. You've got to kiss a lot of frogs before you find a prince, right, in this market, because we came into the Brexit vote saying, my God, you don't want to own the FTSE. It's full of commodity companies, it's full of banks, it's full of insurance businesses that are at the moment struggling, both with the low growth and the fact that we've got very low interest rates. All of a sudden, post-Brexit, we get a rally here, and everybody thinks they're a genius if they're sat in the FTSE. Tom, it just doesn't feel right, does it? This is not going up because of fundamentals, it's going up for other reasons.
I think that's a fair challenge. I think that there is an element of one-off here. You know, there's clearly been a repricing of assets due to the movement in the pound. That's certainly true. But, you know, you look longer term, you know, in a low growth, in a low interest rate environment, then, you know, the big earners in the big dividend payers, especially the dollar dividend payers in the FTSE 100, look like a relatively safe haven.
What? BP?
Exactly.
Shell?
Well,
at 8% or whatever they're...
Well, 6.5 now, BP.
Is it 6.5?
Yeah. Well, I mean, you know, obviously when you start getting above 6-7%, well, then it's you don't believe the dividends. But, you know, and you know, you're always going to be able to find specific examples where that's not true. But as a generality, I think that's the case.